Imagine finding this like completely legal loophole that lets you borrow millions of pesos from a bank, deduct the interest on that loan from your corporate taxes, and actually make a guaranteed risk-free profit off the government.
Right, which sounds totally absurd.
It sounds a little bit like a financial crime, honestly. But, well, for a long time, businesses were doing exactly that. That is, until the Bureau of Internal Revenue finally woke up and just shut the whole thing down.
Yeah, they really had to. And it is one of the most brilliant traps the examiners use now because it targets a very natural assumption about how interest work.
Exactly. So welcome to a special ICPA Review Radio edition of our Deep Dive. If you are tuning in right now, you are a determined CPA candidate currently grinding through your review for the board exams.
We see you. We know the immense pressure you are under right now.
Oh, absolutely. And we are here to help you navigate some of the trickiest waters in the syllabus. Today, our mission is to dig into the absolute heart of the taxation board exam, which is allowable deductions from gross income under sections 34 through 42 of the National Internal Revenue Code.
Along with, of course, the crucial updates from RA 11534, better known as the CREATE law.
Right, the CREATE law. You're going to see that everywhere.
You really are. And mastering these rules is a non-negotiable part of your review. I mean, the taxation exam is notoriously sequential.
Yeah, like a domino effect.
Exactly like that. Any single computational error you make when calculating an allowable deduction will immediately snowball into an incorrect net taxable income.
Which then leads to an incorrect final tax due.
Right. And you can absolutely bet the examiner will have that mathematically flawed answer waiting for you in option A, B, C, or D.
They always do. It's so frustrating. So we're going to walk through the highest yield provisions, decode the real world logic behind them, and, expose those multiple choice traps.
Let's start with the absolute baseline, the bread and butter of business expenses.
Right. So for an expense to be deductible, it has to meet some standard criteria. It needs to be ordinary and necessary, paid or incurred during the taxable year in carrying on a trade or business, and substantiated with official receipts.
But where the exam really gets you isn't on the basics. It's on the special incentives.
Yeah, that brings us straight to one of the biggest updates from the CREATE law, which is the additional deduction for labor training expenses.
Right. The government essentially wants to turn private businesses into a training ground for the workforce. So to incentivize this, they introduced a rule where you can deduct an additional 1/2 or 50% of the value of labor training expenses.
I always picture this like a buy one, get half off tax coupon.
That's a good way to look at it.
But the trap for the exam is that this coupon is only valid at very specific government-approved stores. A lot of candidates think they can just slap a 50% bonus on any training expense.
And that will guarantee a wrong answer on exam day. The criteria are incredibly strict. First, the deduction only applies to enterprise-based trainees.
Okay, got it.
Second, the trainees must be enrolled in public educational institutions. So, specifically, public senior high schools, public higher education institutions, or public technical and vocational institutions.
Wow, okay.
And third, it has to be covered by a formal apprenticeship agreement under the labor code.
Which means, wait, so if a business brings in an intern from like a prestigious private university and spends a fortune training them, they get zero bonus deduction.
Exactly, zero bonus. I mean, they can deduct the actual training expense as an ordinary business expense, sure, but that extra 50% bonus is off the table entirely.
Ouch. Okay, so public school is only for that bonus.
Right, but you also have to watch out for the mathematical ceiling. The law caps this additional 50% deduction so that it cannot exceed 10% of the direct labor wage.
Let's put some numbers to that just so you can really visualize the exam problem. Say a company's direct labor wage for the year is 1 million pesos.
Okay, 1 million.
And they spend 300,000 pesos on a qualifying training program with a public technical school. The bonus deduction is 50% of that training expense, which is 150,000.
Right.
But wait, we got to check the cap. 10% of the 1 million direct labor wage is only 100,000 pesos.
Exactly. So on the exam, your allowable bonus deduction is capped at 100,000, not the 150,000.
It's a two-step calculation every single time, then.
Every single time. First, find the 50% bonus, then immediately test it against the 10% direct labor ceiling. Whichever is lower is your additional deduction.
Right, okay. Now, since we just established that private schools don't trigger that specific training bonus for the businesses hiring their students, I don't want you to think private educational institutions are left out of the tax perks altogether.
Oh, no, not at all.
They actually have a highly testable option of their own when it comes to capital expenditures, right?
They do. Most regular businesses have to capitalize major expenditures, like, say, constructing a new building, and depreciate that cost over the asset's useful life.
Which takes years.
Decades,
Yeah.
sometimes. But private educational institutions get a rare choice. They can either capitalize and depreciate that school expansion, or they can choose to deduct the entire capital outlay immediately as an outright expense in the year it was incurred.
Oh, wow. That is a massive tax shield in a single year. And it's a classic exam distinction. But before we move away from general operations, we have to touch on the dark side of business expenses.
Oh, Ibs.
Bribes. A candidate might overthink this and say, well, the bribe was absolutely necessary to secure a huge government contract that saved the company, so it's a necessary business expense.
Yeah, don't fall for that.
Yeah,
The fundamental doctrine here is that the government will never subsidize illegal acts.
makes sense.
Right. So bribes, kickbacks, and other similar payments to government officials or even to private entities are explicitly non-deductible, regardless of how necessary they were for revenue generation.
Okay, so let's shift gears from paying employees and, well, illicit vendors and talk about paying the bank and the government, financing and tax expenses.
Which brings us back to that crazy loophole you mentioned at the very beginning of this deep dive.
Yes, the famous interest expense arbitrage rule. So here was the scheme before the law changed.
Walk us through it.
Okay, I have a business with 1 million pesos in extra cash. I deposit that cash in a bank, earning interest income. That interest income is only subject to a final withholding tax of 20%.
Right.
Meanwhile, to actually fund my business operations, I go to a different bank, borrow 1 million pesos, and pay interest on the loan. If the BIR let me fully deduct that interest expense against my regular corporate income tax rate, which is generally much higher than 20%, I am literally making a profit on the tax rate differential.
You're playing the spread with the government's money,
Exactly. It's wild that people could do that.
which is exactly why the tax code stepped in to crush that loophole. Under the current rule, your allowable interest expense must be reduced by an amount equal to 20% of your interest income that was subjected to final tax.
And that 20% rate was standardized by the CREATE law, right?
It was. It effectively neutralizes the tax advantage of hoarding cash while simultaneously borrowing.
Okay, that makes total sense. But let's talk about another massive trap examiners love to use regarding interest, specifically for cash basis taxpayers. I see this trip up reviewees all the time.
The prepaid interest trap.
Yeah. Suppose I am a cash basis taxpayer. I borrow 100,000 pesos from the bank, but the bank deducts 10,000 pesos of interest upfront as a discount and only hands me 90,000 pesos in loan proceeds.
A very common scenario.
Right. So since I am on a cash basis and the cash never hit my account, I essentially paid that interest in advance. I should deduct the whole 10,000 pesos this year, correct?
You'd think so based on pure cash flow. But actually, the BIR looks at the economic reality of the loan. For a cash basis taxpayer, advance interest paid through a discount is only deductible in the year the indebtedness is actually paid or amortized.
Wait, really? So if it's a 2-year loan payable in equal monthly installments, I can't touch that 10,000 peso deduction on day one?
Nope. You have to slowly deduct it as you pay off the principal over those 24 months.
Wow. You do not get the full deduction upfront just because the bank withheld it from your proceeds.
Precisely. Write that down because it will be an option on the exam.
Definitely. Now, what about deducting taxes themselves? Obviously, you can't deduct the Philippine income tax you're currently trying to calculate, but the list of non-deductible taxes can be tricky to memorize.
It can be a lot.
I actually came up with a mental block when I was reviewing this, so I used the acronym IELD. IELD.
IELD. I like that. It's a great tool for multiple choice questions. Let's break out the letters.
Okay, so I stands for income tax. E is for estate tax. L is for local assessments that tend to increase the value of your property.
Like the local government paves the dirt road in front of your factory and charges you a special assessment for it.
Exactly. You can't deduct that because it's adding to your assets value. And finally, D is for donor's tax. So if you see any of the IELD taxes in a list of expenses, you just zero them out of your deduction calculation.
The one area that gets complicated, though, is foreign income tax.
Oh, yeah.
Income taxes paid to a foreign country are generally deductible. However, the taxpayer has a choice. They can signify in their tax return their desire to claim those foreign taxes as a tax credit instead.
Which means reducing their actual tax bill dollar for dollar or peso for peso rather than just reducing their taxable income.
Right. But you cannot double dip. You cannot claim both a deduction and a credit for the same foreign tax.
Obviously.
And if you opt for the tax credit, you have to run it through strict global and per-country limitations based on the ratio of your foreign taxable income to your total taxable income.
That sounds like a nightmare calculation.
It is. For the exam, usually the deduction is safer unless they specifically give you all the data to calculate the credit limits.
Good tip. Okay, we've covered the taxes you pay when business is booming, but what happens when the bottom falls out? When a typhoon floods the warehouse or a massive client goes bankrupt? The BIR doesn't just automatically take your word for the loss and hand you a tax refund, do they?
They certainly don't. The rules surrounding the net operating loss carryover, or NOLCO, are heavily scrutinized.
Okay, walk us through NOLCO.
Well, the general rule allows a business to carry over a net operating loss as a deduction from gross income for the next 3 consecutive taxable years immediately following the year of the loss.
3 years. But the examiner isn't just going to ask you to remember the number 3. They are going to test the conditions that allow you to use that NOLCO, particularly the ownership continuity requirement.
Yes, this is a huge anti-abuse provision. A NOLCO is only allowed if there has been no substantial change in the ownership of the business.
Define substantial change for the exam.
The law defines it as a shift, where less than 75% of the nominal value of outstanding issued shares, or less than 75% of the paid-up capital, remains held by the same persons. In short, the original owners must retain at least 75% control.
And the reason for this is fascinating. Without this 75% rule, a highly profitable, booming corporation could just go out and buy a bankrupt, failing company for absolute pennies.
Exactly. They wouldn't care about the bankrupt company's actual business.
Right. They would just be buying it to acquire its massive net operating losses. Then they'd use those inherited losses to wipe out their own massive tax liability.
It's called trafficking in loss corporations. The 75% rule ensures that the people who actually suffered the economic pain of the loss are the ones who get to benefit from the future tax relief.
There is one industry exception to that 3-year NOLCO rule, though. Mining operations, specifically excluding oil and gas wells, get a very generous 5-year carryover for net operating losses, provided those losses were incurred in any of their first 10 years of operation.
Right, because mining is incredibly capital-intensive up front and takes years to turn a profit.
So make sure you spot the word mining in any exam question. Now, what about casualty losses? Say a fire destroys a bunch of inventory.
The calculation of the loss itself is usually straightforward. It's the replacement cost or book value, whichever is applicable. The exam trap here is the strict compliance timeline.
The 30 to 90 days rule.
Yes, a declaration of loss must be submitted to the commissioner between 30 to 90 days from the date of discovery of the casualty or robbery.
Because the BIR needs to be able to send an inspector to look at the ashes before you clean up the site and inflate the numbers on your claim.
Exactly. If the exam problem casually mentions that the taxpayer filed the notice of loss on day 105, your allowable deduction for that casualty is an automatic 0.
Speaking of zeroing out losses, we have to talk about artificial losses generated in the stock market. Section 38 deals with wash sales. I always explain a wash sale using a retail analogy. Imagine you buy a very expensive jacket for 5,000 pesos. A week later, you see the store has dropped the price to 3,000. You are annoyed. So you take the jacket back, return it for a refund, and then immediately walk right back to the rack and buy the exact same jacket for 3,000. The store manager would look at you like you're out of your mind.
Right, they'd be so confused. But in the stock market, people try to do this all the time to harvest tax losses.
How does the BIR define it?
A wash sale occurs when a taxpayer sells shares at a loss, but within a 61-day window, which is 30 days before the sale, the day of the sale itself, and 30 days after the sale, they acquire substantially identical stock or securities.
So the BIR disallows the loss because under the economic substance doctrine, your position hasn't actually changed. You just generated a paper loss to lower your taxes, but you still own the exact same asset.
Precisely. The only way around this on the exam is if the taxpayer is a registered dealer in securities, doing this in the ordinary course of their business.
Right. And the BIR applies that same logic, the economic substance doctrine, to Section 36, which covers related parties.
Yes. Losses from sales or exchanges of property between certain related parties are explicitly disallowed to prevent tax manipulation.
Because if you have a piece of land that dropped in value, you can't just sell it to your brother for a massive loss, claim the tax deduction, and still keep the land in the family. It's a sham transaction.
Exactly. You need to memorize the list of related parties. For tax purposes, family is strictly defined as spouses, siblings, ancestors, and lineal descendants.
Does it include in-laws?
No, strictly those bloodlines and spouses. It also includes sales between an individual and a corporation where that individual owns more than 50% of the stock. And finally, transactions between a grantor and a fiduciary of a trust. Any loss generated between these parties is ignored.
Okay, so we've covered losing money by accident and trying to fake losing money. Let's talk about giving it away on purpose and how to avoid the headache of tracking every single receipt.
Ugh, charitable contributions. For this, the exam will test whether a donation is fully deductible or subject to a limited deduction. Donations to government priority projects in education or health, or to accredited non-government organizations, are generally fully deductible.
But there is a massive trap regarding those accredited NGOs. An NGO might be accredited, but to qualify for the donor's full deduction, that NGO cannot have administrative expenses exceeding 30% of their total expenses.
This is a huge one to remember.
Right. If the multiple choice question gives you a scenario where the NGO spends 40% of its budget on admin and salaries, the donation is no longer fully deductible. It gets bumped down into the limited deduction category.
And those limits are rigid. It's 10% for individual taxpayers and 5% for corporate taxpayers. But the crucial step that candidates miss is the base calculation.
What's the base?
This percentage is multiplied by the taxpayer's taxable income derived from trade or business before deducting the charitable contribution itself.
Before. Highlight that word. Okay, now let's talk about the absolute favorite topic of exhausted accountants everywhere. The optional standard deduction, or OSD, under Section 34L.
The ultimate easy button.
Literally, instead of gathering thousands of official receipts, calculating depreciation, and proving every expense, you just multiply a base number by 40% and you're done.
But this is one of the most tested concepts on the board exam because the base is not the same for everyone.
I'll admit, when I first studied this, I thought you just take 40% of everything and called it a day.
Oh, that is a fatal error on the exam. The 40% rate is universal, but the base it applies to is completely different depending on the taxpayer. For individuals, the 40% OSD is based on gross sales or gross receipts.
Meaning you do not deduct the cost of goods sold, right?
You do not. For corporations, however, the 40% OSD is based on gross income, which means for a corporation, you absolutely must deduct the cost of goods sold first and then multiply the remainder by 40%.
The mathematical difference is staggering there. Let's say we have a business with 1 million pesos in sales and 400,000 pesos in cost of goods sold.
Let's run the numbers.
If you are a sole proprietor, an individual, your OSD is 40% of the full 1 million. That's a 400,000 peso deduction. But if that exact same business is a corporation, you first subtract the 400,000 cost of goods sold from the 1 million in sales,
leaving a gross income of 600,000.
Exactly. The corporate OSD is 40% of that 600,000, which is only 240,000 pesos.
It's a huge gap. The rationale here reflects the inherent structures of these entities. Corporations generally deal heavily in goods with massive costs of sales. If the BIR let corporations apply 40% to gross sales, many corporations would wipe out their entire tax liability without actually proving any operating expenses.
It levels the playing field.
It does. Also, keep an eye out for general professional partnerships, or GPPs. A GPP and its partners can only avail of the OSD once. Either the partnership claims it in computing its net income, or the partners claim it on their individual returns. No double dipping.
No double dipping. We are on the home stretch. Let's zoom out from the daily operations and talk about selling off major assets or restructuring the whole company, sections 39 and 40.
To navigate capital asset transactions, you first have to define what a capital asset is, and the tax code defines it negatively.
What does that mean, negatively?
A capital asset is essentially everything you own that is not stock in trade, not inventory, not property held primarily for sale to customers in the ordinary course of business, and not property used in the trade or business subject to depreciation.
So if a company sells its delivery truck, that's an ordinary asset because it's depreciable business property. But if the CEO sells his personal antique watch collection, that's a capital asset.
Correct. And here is where individuals get a specific break that corporations do not. For individuals, the holding period dictates how much of the capital gain or loss is recognized.
Right, the 12-month rule.
Yes. If the individual held the capital asset for 12 months or less, 100% of the gain or loss is recognized. But if they held it for more than 12 months, only 50% is recognized.
But corporations don't get that 50% discount, do they? It's always 100% for them, regardless of the holding period.
Exactly. Individuals also get the net capital loss carryover. If an individual has a net capital loss in 1 year, they can carry it forward to the succeeding taxable year as a short-term capital loss. However, it is limited to the amount of their net income in the year the loss was actually sustained.
Now, what if a business wants to restructure? Section 40 covers tax-free exchanges. Let's say I own a massive commercial building personally. I want to form a new corporation and transfer my building into it in exchange for shares of stock.
You're just changing the legal form of ownership.
Right. I don't want to pay a massive capital gains tax on that transfer because I haven't really cashed out. I just went from being a sole proprietor to a shareholder.
The law protects that specific maneuver. No gain or loss is recognized if property is transferred to a corporation by a person or a group of persons not exceeding 4 in exchange for stock.
Not exceeding 4.
All right, but the catch is, as a result of that exchange, those transfers must gain or maintain control of the corporation.
And control means owning at least 51% of the total voting power of all classes of stock entitled to vote. But here is the curveball question that examiners love.
Oh, I know where you're going with this.
What if I transfer that building, I get the shares to achieve my 51% control, but the new corporation also hands me some cash on the side to sweeten the deal? Does that cash blow up the entire tax-free nature of the exchange?
Not the entire exchange, no. This introduces a fascinating tax concept called boot.
And before you explain the math, we have to talk about why it's called boot. It's such a weird word. It actually comes from the Old English word bot, which means an advantage or an addition. Like the phrase, I'll trade you my horse for your cow and I'll give you a bag of gold to boot.
Oh, I love that.
Yeah, it just means in addition to. So in tax, boot is the extra money or property you receive in addition to the tax-free stock.
That's a perfect way to remember it. The receipt of boot does not destroy the tax-free nature of the core transaction. However, the gain is recognized up to the amount of the boot received.
Let's do the math on that.
Sure. So, if your total mathematical gain on transferring the building was 500,000 pesos, but the corporation only handed you 100,000 pesos in cash as boot, you only recognize and pay tax on that 100,000 pesos.
Got it. And there is a monumental update from the CREATE law regarding these tax-free exchanges that you absolutely must have started in your review nights.
Yes. Prior to RA 11534, taxpayers often had to secure a prior ruling or confirmation from the Bureau of Internal Revenue to avail of this tax exemption. This is a massive bottleneck.
Huge headache.
But the law now explicitly states that prior BIR confirmation or tax ruling is no longer required to avail of the tax exemption for tax-free exchanges.
That is going to save accountants years of paperwork. All right, we've covered a tremendous amount of highly testable ground today. Let's lock it in. Give us the exam day checklist, the rapid-fire recap of the most testable computational numbers we covered.
Okay, here's your 4-point checklist. Number 1, the labor training deduction is an additional 50% of the expense, but it maxes out at 10% of the direct labor wage, and the trainees must be in a public school.
Check.
Number 2, your interest expense deduction must be reduced by 20% of your final tax interest income to prevent arbitrage.
Check.
Number 3, the OSD bases are a trap. It's 40% of gross sales for individuals, but 40% of gross income for corporations.
Don't forget COD-GS for corporations.
Exactly. And number 4, for a tax-free exchange, the control threshold is 51% of voting power, and thanks to the CREATE law, no prior BIR ruling is needed.
Brilliant. As we wrap up this deep dive, I want to leave you with one final strategic thought drawn from Section 41. If you are ever asked about inventory valuation changes on the exam, or if you're dealing with a client in your future practice as a CPA, remember this strict limitation.
It's a strict one.
The commissioner will not allow a taxpayer to change their inventory valuation method more than once every 3 years. Tax planning isn't just about figuring out this year's return. It requires a multi-year chess strategy. You can't just flip from FIFO to weighted average and back to FIFO every time the market changes just to manipulate your tax bill.
It requires looking at the entire board. Financial accounting might strive for perfect precision in a single moment, but taxation is about understanding the boundaries the law sets over the long haul.
Perfectly said. To you, the CPA candidate listening right now, keep pushing through your review. The rules might seem overwhelming, but every limitation you memorize and every loophole you understand gets you one step closer to that license.
Stay energetic, trust your preparation, and remember you have exactly what it takes to pass this board exam.
Keep studying, and we'll catch you on the next deep dive.